Hello again. Carlos Scarpero here, VA mortgage specialist with Ross Mortgage and Military Mortgage Boot Camp. Today I want to talk about the interest rate reduction refinance loan, also called the EARL loan. This is a really interesting program for veterans that have a VA loan currently that want to take advantage of today's lower interest rates. I don't know if you've been paying attention to the news at all, but right now rates have been going down for the last few months. Right now is a great time to refinance. And so the EARL loan is a streamlined program to help veterans get into a lower interest rate on their VA mortgage loan. Now, it's a little bit different than just doing a straight refi, the cash out refi with the VA loan, which is another option. With the EARL, it's really nice because there's no appraisal due. We don't really check income. There's not a heck of a lot we check because the feeling behind it is that if you're able to pay your bills on time now at whatever 5% or whatever you're paying, then you should be able to pay your bills at 4%. And so I'm going to go through some frequently asked questions about the EARL program, and hopefully that'll help. And as always, if you have any questions, feel free to reach out to me. So what is the EARL program? It is called the Interest Rate Refinancing Loan. And so it's a streamlined refi to help you get your VA mortgage loan. So what are some pros and cons? So on the pro side, the underwriting is a lot easier. And on the con side, it's not appropriate in every situation. Sometimes the cash out refi is a better option for you. So how does that differ from the VA cash out refi? The EARL is a VA to VA refinance program. As opposed to the VA cash out refi, you can pay off conventional loans with it, you can pay off FHA loans with it, you can pay off second mortgages with it, you can take cash out and buy a car with it, you can do roofing repairs with it, all kinds of things with VA cash out. So the EARL is just a VA to VA straight, streamlined refinance of your VA loan. Do you need an appraisal with the EARL? No, typically no. Unless the lender is charging more than one discount point, which we don't, but if they were, then appraisal is required, but in most cases it's not required. Are there credit income requirements? Typically no. I've already gone through this. As long as you don't have a lot of delinquencies on your mortgage. But what's really interesting is you can actually have late, you can even be behind, and in certain cases you can get exemptions to bring a past due mortgage current. So it really depends on the situation, but in most cases we really just look at the mortgage payment history and make sure things are good, and we're good to go there. So you have one thing to consider if there is a mortgage delinquency on the loan is whatever situation happened has to get resolved. So for example, if you lose your job and you've gotten several months behind on payments, and now you have a new job, but for whatever reason, maybe you're making the current payment, but that past due payment just keeps going rolling and rolling and rolling, but you're able to roll that into a new loan. That type of situation is something you can do. If you are out of work and are behind on the mortgage and you're still out of work and looking and that situation not been fixed, then you can't do the EARL to fix that problem. It makes sense. These are common sense loans. It's a great thing I love about the VA mortgage program. Do you need to use the same lender that originated your original VA loan? No, you don't. If you want to use us at Ross Mortgage or any other loan officer that's been trained by Military Mortgage Boot Camp, you can use whoever you want. That does a great job for you. Are there exceptions to the cash out rule? You typically cannot get cash out. There is one exception. Two exceptions. One is if there is a clerical error in the loan and they need to fix that error, then sometimes they will allow cash out for that. Additionally, you can do up to $6,000 in home improvements as long as they are to increase energy efficiency in the property. So if it's proven that you are making the property more efficient, then you can take up to $6,000 cash out to get the home improvements. So it's good to know there. Can you combine a first and a second mortgage? We've already discussed this, and no, you cannot on the EARL program. You would need to do a VA cash out refi for that. How long do you need to be? You need to make 6 payments on your current VA loan. So if you got sucked into a bad deal and 3 months later you want to refi to an Earl, you can't do that. You need to have made 6 payments or be 210 days after closing since your original VA loan closed to get the Earl program. Is there a minimum rate drop? I think this is a really interesting rule. And so this was clarified in the VA Circular 26-18-13 that came out a couple years ago. It says that the new loan has to be at least 0.5% lower than your current VA loan. I really like that because it prevents flipping and any kind of shenanigans that certain lenders like to do. And so to make sure that that doesn't happen, that 0.5% rule is in there. There are exceptions. So, for example, if you're in an adjustable rate loan and you're going to a fixed rate loan, then there are exceptions for that. But typically, you need at least a 0.5% drop to take advantage of the Earl program. And that makes sense because if you're not getting that rate drop, then why are you doing it? Because there's no cash out. That's really the only way to save money is through the rate drop. And what is the recoupment fee? Recoupment rule for the Earl program. There is something called a recoupment rule, and I have not seen this in other loan types. I wish more loans would have this recoupment rule because it really makes a lot of sense. And what it means is that the closing costs associated with the Earl loan need to be recovered in 36 months or less after closing. So, for example, if you have $3,000 in closing costs and you're saving $100 a month, then that would be 30 months. 3,000 divided by 100 is 30. So that would qualify because of less than 36. So what we do is we as the lender would do a worksheet that shows the closing cost of the loan. We do another worksheet shows how much you're saving, and you'd have to be able to recoup that in 36 months or less. There are exceptions because if you're doing a term reduction, so for example, maybe if you're taking it from a 30-year down to a 15-year, then your payment might go up, and that recoupment rule wouldn't apply in those cases. This is really interesting. When I no longer live in the property, can I get the Earl loan? So with the VA mortgage program, you can have a home and then buy a new home and rent out your original home. So say you bought a house on the VA mortgage program, you decided to move to a new house and rent out the first house. Can you get the Earl program on that rental house? Yes, you can. You'll need to certify that you originally had the Earl loan, or that you originally had a VA loan on the property, and that you originally lived there when you purchased the house, not now, but when you purchased the house. Then yeah, you can get the Earl loan. Really cool. How does the Earl affect entitlement? So as you might know, there are some entitlement rules about how many VA loans you can have at a time and balances. It doesn't affect it at all. It's all just rolls right in. What is the term extension rule with the Earl loan? So there is a term extension rule. So with the Earl loan, you cannot extend the term more than 10 years past the original loan. So for example, past what you have left. So for example, if you bought the house 15 years ago, you're currently 15 years into your loan, and you have 15 years left, you can't extend it past 25 years because 15 plus 10 is 25. If you have 25 years left, you can't go over the 30. So if you maybe been in the house 5 years and you decide to do the Earl program, you can put it back on a 30. You can't go into 40 because we don't offer that. You can roll back into the 30. So it's 30 years or 10 years, whichever is less. Is there a funding fee for the Earl program? As you probably know, if you have a VA loan now, there was a funding fee involved unless you are exempt. There is a funding fee involved with the Earl program. It is a lot lower than it was with the original VA loan. With the Earl program, it is 0.5%, and that's for everybody across the board. There are no differences. It's 0.5% of 1%. Now, if you are exempt because of disability payments, then again, there are no, with the Earl, there is no funding fee at all. So pretty cool. You still don't have to pay the funding fee. Can closing costs get financed with the Earl? Yes, they can, but it has to be taken out of the loan to value, and it can't exceed 100% of the property value. So you can't over finance it with the Earl. So that's a really good thing as well. But yeah, you can get your title appraisal, or title work. There's no appraisal, but title work and that type of thing. You can get that finance bureau program. So it's really cool. I hope that helps. I am a VA mortgage specialist here at Ross Mortgage. Military Mortgage Bootcamp graduate. VA loans are my specialty. If you're here in the Dayton market or Cincinnati or anywhere in Ohio or Kentucky, please feel free to reach out to me for any of your mortgage needs. I can be reached at 937-572-3713. My website is scarpero.com, SCARPERO.com. Talk to you soon. Bye.